This week on Sylvia's Traders Lounge.
Whether you're hiring an advisor or you're trying to advise yourself and manage your own money, you have to think in terms of up market, down market, sideways markets. And if you're hiring somebody to do it and maybe they're a buy and hold mutual fund, well, then you have to expect that in up markets, you'll do very well. Down markets, you'll do very poorly. And sideways markets, you'll just sit there and do nothing.
Hi guys, thank you for tuning into today's podcast. We are expecting Tom Basso for our interview today. And Tom Basso, he is a trend follower and we have interviewed him before. He's also big on automation and behavioral economics.
Yeah, so welcome guys. My name is Gilbert and with me is my colleague. Of course, we are going to introduce ourselves and Samuel. And today we're going to be having a follow-up interview with Tom Basso. We have him on our YouTube channel. One of the interviews that we've done with him earlier on. Hello, Tom.
Hey, how you? Good morning. Over here, you're probably afternoon.
Yeah.
Yeah, he's been gracious enough to come on board very early, 5 a.m. his time. So maybe, Tom, you can refresh our memory on what asset classes we're currently looking at.
I currently trade about 25 futures markets, mostly in the US, and I trade about, let's see, right now I have up to, well, I could have up to 40 or so ETFs on various techniques and strategies. I trade 20 different sector funds, and then I trade a momentum-based strategy with ETFs that currently has only 2 positions in it. There's not many that qualify to the upside anymore here. The market's been pretty soft in the US on stocks. And then I do a sideways strategy that involves selling spreads in options on indexes. And I have the hedge strategy that I outline in my website. I use Standard & Poor's futures there and just short them. And right now I do have the hedges on because the market's been soft. And let's see, then I trade a Bitcoin future as an experiment. That's been fun so far. I've had 3 successful trades. It's not super significant, but I'm testing it to see what my fills are and what my slippage is. And that's pretty much it. About 7 strategies across, I think the maximum I've ever seen is about 60 positions.
Are you also still doing all of them on automated trading?
Oh, no. Well, some of them are automated and some of them are not. I'd like to automate them all, but it's not really reasonable. Some strategies like options, for instance, it's very difficult to get historical pricing to do simulation work on options. So I have to sort of, when the markets are open, if I want to put a trade on, and I usually do that about once a week, I have to go in and actually look at the prices and figure out which pair I'm going to do for that particular time. It's very difficult to describe the logic behind that to a computer program. Other things are very easy. Longer term trend following of futures is very automated. So that's pretty easy to do. It just depends on the strategy.
So how do you manage to trade so many different assets at the same time? Do you use different strategies on board, or do you use fund or use automated systems?
Well, the way I do it is like an interactive trading platform, interactive brokers as the trader workstations that you can just go in and all the indicators that I want to use for decision making are right there. And I have sheets of paper that help me decide what my position sizes are going to be per my book on position sizing that came out a couple of years ago. And so what I do is I look at my indicator, say on an ETF, and I can quickly see where my stop is, and I just grab the stop level with my cursor and just move it to where it needs to be. That's done. And sizing the position, if I'm putting a new position on, I need to size the order. I just got to look at a matrix and look at the number and put it in there. And so it's pretty easy for me to handle 20 instruments inside of a couple minutes. And then I'm good for 24 hours. So I don't really, it doesn't strain me too awfully much. I get all my work done in about 20 minutes, 25 minutes on a typical day. Sometimes it stretches all the way out to 35 or 40 minutes if it's a bad day for data or something unusual, some very unusual things happened or something like that. But most of the time it's 20, 25 minutes.
And regarding the exchange traded funds, I think last time you had explained a little bit about exchange traded funds. Is it okay if you could just give us a brief about ETFs, exchange traded funds, and why you choose to incorporate them into your trading?
I choose to do ET. I think there's a little echo there, but I think if you said, why do I use ETFs instead of actual stocks? Is that essentially the question?
Yeah.
ETFs, I've been retired for 17 years now or something like that. And I have very little desire to sit here in front of a computer, although it seems like I do it more and more lately with interviews and things. A typical day, I'd rather be outside in the sun and having either golfing or working on my landscaping or doing other things. Walking my dog behind me there, who required my attention this morning because I woke him up a little earlier than he's used to. ETFs already have some diversification. So what you're doing there is very easily, with one step, eliminating sort of corporate risk. If you trade individual stocks, over time, you will have something with an announcement or a fire breaks out in a plant or just something anomaly that'll come in and hit you very hard in any one day. Your stops will get triggered and you'll have a terrible fill. And if that's a significant part of your portfolio, it's going to hurt. On the other side, stocks have the ability, if you're a young trader and trying to really make it big, of course, an individual stock could go crazy and you'd benefit a great deal from that. But having had a long run in the markets and being retired and just wanting to sort of protect my assets and have appreciation, I can get rid of a lot of that sudden corporate risk by using ETFs generally. So that's the biggest reason I'd use it for. And I use sectors because right now, for instance, there's 7 sectors that are long out of the 20 that I trade. So there are pockets out there where things are still hanging on and moving upward, but more than half, specifically 65% of my positions are now to the downside or to, in cash protected. And so I'm being fairly cautious lately here.
Yeah, you had mentioned about your strategy with the 7 strategies that you're currently using.
Yes.
And so, because you're a sideways and you also trade, you're big on trend following. So maybe you can tell us more about how you execute your trades in a ranging market.
Okay.
Especially or as a manual trader.
Sure. I'm still a trend follower. When I'm doing a sideways action, I'm trying to pick up the tops and bottoms of the noise. So I have things like RSI stochastics that'll give me an indication on the screen of the market is extremely overbought or extremely oversold. If it's oversold, I want to be buying it because I'm figuring there's a range there. So then all I do is I do a short-term trend following on that, which would mean maybe I'm like, for instance, if I'm doing a once a day program and it has to be short term, then what I'm doing is using, say, the previous bar or some very, very short term trigger to trend follow it in the opposite direction. So I'm oversold. and I want to buy it. So I might buy it above yesterday's high or something like that, in order to trigger a trend following trade. And then I'm assuming it's not going to last very long. So I've got ways of taking off part of the position to break even, letting the other part run in case it is a real good long run, but being cognizant of the fact that I'm probably not going to be in that trade for very long, still allowing the trend following to happen, but it's just the nature of it is because of the short-term nature. I'm liable to get stopped out sooner or later pretty quickly. So I'm looking for the bounce off of an oversold to the long side, triggering it with a buy sell engine, moving my stop up as fast as I can. It's trend following. It's just a shorter term trend following.
So going into the quantitative tightening season and the Fed tapering, what sectors will you be looking at to go long or to hold onto the trend now that the Fed is planning to start reducing the bond buying problem?
I don't predict at all. The 7 sectors that I'm in right now are sectors that show a trend following upward motion. And I don't even remember, let's see, I don't have I didn't pull up my my quotes, but I'll do that while we're talking. I think technology is still hanging in there. Where else am I? I usually don't pull this up while I'm doing an interview because it does grab some of the bandwidth, but I've got 100 megabits here, so it should work. So what I'm doing is using trend following models, looking at 20 different ETFs, and when an ETF goes to the downside through the models, it sells me out, and I go to cash. In the case of the 7 that I'm long, and I've never gotten a sell signal, so I'm still in it, and that means those sectors are still strong enough to hold on to. I don't anticipate what the Fed's going to do at all. I don't even think about it. I don't even want to know about it. I do as a citizen of the U.S. and the world, but in terms of my trading, so like right now we've got the banking industry is still hanging in there. Aerospace industry is still hanging in there. It got so beat up during COVID that it started to the upside and has been hanging in there. Energy exploration is shown some strength in energy, and the finance firms. And consumer discretionary. Those are the 7 sectors that are currently doing all right.
Okay. And then at what point do you decide to use a stop loss vis-a-vis using or hedging or buying puts or using immediate?
Yeah, on the ETFs, I use a 21-day combination of Keltner, Bollinger, and Donchen to buy, and I use a 50-day Keltner, Bollinger, and Donchen to sell. It's slanted to the upside. I'm a little more sensitive to getting into a position than I am to get out of it, but I have in both cases hard stops there, and when they hit, I'm executed. I don't even have to be here. I could be out working on the landscaping or whatever I want to do that day, running errands or playing golf, makes no difference. And the stops are executed, and I'm either in or out depending on which way I'm going.
And maybe what's your take on China and what's currently happening to China with regards to the CCP and their crackdown on tech stocks? What do you think is the reason why most traders, like in US, usually don't invest in Chinese companies? even if there are very major Chinese firms out there. Why have people been sticking? And this is before what we saw with the CCP. Why is it more
Yeah,
people prefer US than Chinese?
my reaction is China. Having been there a couple of years ago, I've seen the empty buildings. The you know a centralized decision-making process, I think, is the worst of economies. I'm a very free economy believer. I'm more of, if you've ever read Atlas Shrugged, it's a great book by Ayn Rand. It speaks to the psychological and societal problems of having central governments control what goes on in that economy. It's highly inefficient because each individual has his or her own, what's in economic terms called utility. They make a decision based on their own benefit and their own well-being and their own satisfaction. And when you collectively take a whole bunch of individuals and put them together that way, it's very powerful, because through the normal supply and demand pricing and allocation of whatever available goods there are, everything finds its level to the maximization of each individual. So from a society standpoint, it also creates maximum utilitarianism, or whatever you want to call it, utilitarian factors. In China, they've spent a lot of resources doing certain things. They've not spent enough to do other things. And so you've got lots of dislocations. I don't think their economy is all that great. They've clamped down on Hong Kong. They've clamped down on the tech stocks. So freedom is not their thing at all. And that's to keep the CCP in power. Eventually, that will, over the short run, it allows them to stay in power. Over the long run, it turns the country into a second-class country. It's never. It could be powerful. It could be dangerous even to the world in terms of taking over things, but it ends up being something that I don't think is a good long-term position for me, especially in retirement. CCP has already shown that they can change the rules on anything at a moment's notice, and I just don't want that kind of risk in my portfolio. There's no reason for me to have that. Things are a bit more predictable. Heck, they're even unpredictable here in the United States, and it's far more predictable than it would be in the CCP. So it's there's enough risks out there. I don't need to add that one to the list.
All right. I think you can also, because I know you've written a book on panic-proof investing, as a long-term, because you've been in fund management for some years, maybe you can tell us what investors and traders alike can really pick up from that book, number one, in regards to the current market situation globally.
I guess for normal investors from panic-proof investing, what you have to realize is that whether you're hiring an advisor or you're trying to advise yourself and manage your own money, you have to think in terms of up market, down market, sideways markets. And if you're hiring somebody to do it, and maybe they're a buy and hold mutual fund, well, then you have to expect that in up markets, you'll do very well. Down markets, you'll do very poorly. And sideways markets, you'll just sit there and do nothing. That's pretty simple to understand. If you're hiring a trend follower, for instance, then you know that you're going to be perhaps long for much of a bull market and therefore making money. And if you're to a downside and you time out of it, you're going to be in cash a lot. So you're going to be earning interest rates. And during sideways, there's going to be some in and out and in and out. And some of those are going to be losers. So you'll tend to lose a little bit along the way during sideways periods. Sideways periods in the stock market run about 2/3 of the time in rough terms. And long or short markets, bull or bear markets, run about well, let's see, about 7-9%, something like that in the case of bear markets, and the rest of the third, which would be somewhere around 25% or so, 26% would be bull markets. And that's kind of the way the last 40, 50 years has worked out. Next 50 years could be slightly different. I wouldn't expect it to be hugely different, but it could be. But basically, you're going to be sitting around a lot, going sideways and being patient and getting whipsawed every now and again. And sometimes down markets, you're going to sit there earning interest, which seems awfully boring after some of the returns we've seen in stocks around the world in the last 10 years or so. So I think you have to mentally prepare yourself. And that's what that book was trying to get across, was to try to do some planning ahead of time and keep yourself out of some of the difficulties that investors seem to put themselves into by just not getting into them in the first place. I don't know if that answered your question. I tried.
Yeah, it does.
Yeah. And there is another book that you've written. I think it's is it self-published, The Frustrated Investor?
The Frustrated Investor is the same book as Panic Proof. When Wiley gave me the contract to take my privately published book, Frustrated Investor, and turn it into a book for through Wiley and go public with it, they had me add an extra chapter. We added an outline at the end of the book, which was a checklist. And so it's slightly expanded book. And then they retitled it. They wanted to retitle it as Panic Proof Investing. I thought Frustrated Investor was a better title myself, but it was their publishing. So we went with it.
All right, and then maybe you can, with the long-term investors, there's this common phrase in trading that says, sell in May and go away. Sell in May and go away in regards to seasonality and trends. Maybe you can tell us more, your thoughts on that common phrase.
I believe you said sell in May and go away. Is that?
Yes.
Yeah,
Yes.
yeah. That some of the what I call there's order in the universe indicators. That's what I call that type of an indicator. There's also the NFL Super Bowl indicator. If the NFC wins, you're supposed to get a bull market, and if the AFC wins the Super Bowl, you're supposed to get a bear market for the year. And there's other ones that, like the first day of the year, first week of the year, indicates what you're going to do for the year. So if the New York Stock Exchange is up for the 5 days in January, first 5 days in January, then you're supposed to have a positive year on balance. All those types of indicators are, in my mind, something called there's order in the universe. And I've seen newsletters based on the phase of the moon driving the stock market. I've seen the people that believe in cycles, that cycles are always there. And if you get enough combination of different cycles, you can predict what's going to happen. You've got Elliott wave people that talk about, there's the A's and the B's and C's and different pullbacks and all that stuff. And all of those are trying to predict the future. You're trying to take whatever you want and say, okay, it's May, so we should sell. And I'm predicting that we're going to have a bad summer, and then we come back in whatever, September, October. That sometimes will work and sometimes won't. I think it's, to me, trying to predict and trying to trade successfully are it's a lot more effort and iffiness, if you want to call it that. It's just not worth it. You're going to be just as unreliable doing that as flipping a coin almost, and the coin might even be slightly better because it doesn't have any emotion, and you will have emotion trying to take this prediction and deal with it. So to me, you just measure what the markets are doing and go with it. That's why I've probably stuck around for 45 years of trading and still doing it, still learning and still, getting better at it, I would say. I think what you end up with when you try to lock yourself onto the mentality that May is when you sell and go away, if you have a June, July, August that happens to go crazy upward and you're making new highs, then you just missed it. That could be your biggest profit for the year. And there's no law that says that the market can't go up for the first 5 days of January and then have a terrible year. There's no reason why that can't happen. So I just think it's better to just every day position yourself the way you should be positioned and get out of the predicting game. Don't worry about what the Fed's doing. Don't worry about what China's doing. The prices of the market will tell you whether the market is reacting to that news or not. And you don't need to worry about it. The market will tell you instantly.
And maybe just one final question. I know I've never asked this to any of our guests, but I think I'm going to ask you. You've been, like you said, you've been in this industry for quite some time. Have you gotten to that level where you would want to pass down that knowledge to maybe one or two people that you take on as an apprentice or an apprentice, so that they can carry on your work and probably build up on that and even go further than that? Have you gotten to that point in your career?
Well, in my own way, I have. What I did with enjoytheride.world as a website is created the ability for thousands of traders to access interviews that I've done and research papers I've done, and interviews like this. I've spent time hopefully helping a lot of traders out there. There's nothing that I'm doing that is that proprietary. I mean, I just told you exactly what I'm doing with my sector timing program. I even gave you the 21 and 50 day parameters. Uh, I thought I'd spare you all the other little details because you could find those out yourself. I mean, I use 2.0 times for Keltner and I use 1.5 times for Bollinger's. The Donchin's just a simple 21 or 50. There's no other parameters. And you can pick 20 sectors yourself. So, I mean, I've just given you and everything I do. I've written a position sizing book that has the exact math I use for my position sizing. Sitting here for 20 to 25 minutes looking over my shoulder for somebody would do nothing for them. It's the same stuff I just told you. So I've tried in my own way to spread the knowledge as far and wide as I can. And there's a lot of people out there that have become a little bit more through questions over time, more, I guess, experienced and seasoned, you might say, just that I've known for 10 or 20 years. Lawrence Bensdorf's one of them, the guy that I do the seminar with in Scottsdale coming up in November. He talked to me I want to say 10 to 15 years ago now. I had just retired and he sought me out and asked me a lot of questions and kept in touch. And he's now he teaches other traders how to trade in the Trading Mastery School out of Brazil now. And he's electronic and virtual. So he has traders all over the world, Australia, Europe, speaks 6 languages, I believe. The guys like that I've run into over time have taken it on themselves to expand their own knowledge. And they've not only asked me questions, they've asked a lot of questions from a lot of people and put together their own knowledge base and their own seasoning to deal with losses, the mental side of trading. And a lot of traders don't make it. They want to know my formulas, but they don't want to do anything to get their structure right, to get their capital base properly capitalized. They're trying to make a 1,000,000% on a $1,000 account. That's very difficult to do. You've got no diversification. You got to be over leveraged. You're rolling the dice, and a lot of people are not going to make it when you do that. So the seasoning process gets you to where you're running a business. You're not just a trader anymore. You're running a business of trading, and you're watching your risks. You're diversifying just like you would any business. You're properly capitalizing your business. You're properly providing backups for your business. So if the power goes down or the internet goes down, or you have backup plans, if your computer fails, you have a backup computer. All these types of things is what you would do if you were running a business. And I think that's what seasoned traders do better than new traders. And so mentoring, in terms of somebody following me around all day, I think you'd be sorely disappointed, and you'd be wondering, well, what? It's got to be more complicated than this. It isn't. People want to make it more complicated. It isn't.
All right. And then, Tom, maybe you can tell us, with the 45 years in the industry, and also being ranked as a market wizard by Jack Schwager, do you have one mantra that you live by to date? Like more like a trading philosophy that you live by today?
I have several. The number one thing everybody should remember and have a little sign on their wall is the market will do what the market will do. Don't, by trying to predict, the market doesn't care about your prediction. It will do what it wants to do. If I'm long crude oil going into the first Iraq war, when H.W. Bush, the first Bush, we went in from Kuwait, and oil went to $40 overnight, and then was $22 the next morning, starting from 32. So 32 to 40 to 22, all in 12 hours or something. And the markets will do what they want to do. It was long going into the evening, and it was short by the time I walked into the work in the morning, and we had just lost 6% of our entire portfolios, which was worth at that time millions and millions of dollars. And the markets will do what the markets will do. That's the first thing. The second thing I think is something I've said a lot is concentrate on the process, let the results take care of themselves. It applies to sports. It applies to playing what we call soccer, you call football. It applies to so much in life. Trying to lose weight. If you concentrate on the process of eating healthy and working out, you're going to have a better health than you would if you tried to go on some kind of a fad diet and just try to, like not eat for 5 days or something. I think concentrating on the process and letting the results take care of themselves is everything. Last year, I think I did 103%. I didn't try to do 103%. I wasn't obsessed with it. I wasn't nervous about it. COVID caused a huge down move in all the stock markets. So all my trend following models and the ETFs put me to cash. My hedges made a lot of money. My futures went crazy because things like palladium and some other things just were going nuts, and I was running those trends. Then the thing came down and turned around, and everybody was trying to predict, we're going to have a test of the bottom, we're going to do this, I don't know if we want to get in because COVID's still going around, and the whole world's going to end, and there was all this predicting going on. I got buy signals on my ETFs, became fully invested, went long, took off all my hedges, went long on my short-term stock index trading, and ended up with a huge move up towards the last part of the year. So I made money in the first part going down. I made a lot of money going the other way. It comes out to 103%. I was concentrating on the process. I didn't change a single thing that I do. I just did what I do. Same thing I did the year before. And, it's the markets that gave me that 103%. It wasn't me doing anything special or me being overly smart or predicting that all these things would happen. I didn't do any of that. I just came in every day and did my 25 minutes and did the same orders that I always do. And I think that's the seasoning that comes with having seen this a lot over 45 years or whatever, how long I've been doing this now. And I think that's the other thing that I would encourage people to think about. So concentrate on the process.
All right, and that means that every trader should have a system-based trading approach.
Yeah, systems trading is what a lot of people would call it, what I do. But I would argue that even like a Paul Tudor Jones, who's supposed to be a discretionary trader, probably reproduces in his own mind or is in his own, whatever the market action is, there's a certain routine, let's call it, that he would go through probably to do what he does. A Mark Minervini who looks for, I think what he calls contracting volatility or something. He sees that markets are compressing and he uses that to set up a trade and then jump on it. It doesn't have to be, run by computer. To be a good trader, I think you have to be somewhat consistent in what you do, but it doesn't have to be computerized. I happen to be an engineer, so it's just easier for me to do that than some people. I think there's lots of room for people to invent their own ways that fit who they are, not try to copy me or copy Paul Tudor Jones or whoever. Come up with your own strategy that works for you and fits your time limits and fits your capital that you're trading and fits the markets that you're able to access. You can't, and there's lots of countries in the world that can't access the US futures markets, for instance, or in Europe, they've outlawed, or the EU, I think, doesn't allow you to trade the SPY. That's the largest traded instrument in the United States. On the exchanges, the ETF on the Standard & Poor's 500 stock index, I believe that's not allowed in the EU. I heard, strangely, I don't know why. It's somebody made a decision someplace. So not everybody can do everything that I do. And you might have access to markets that I wouldn't have a clue, haven't looked at, don't know how I would even get to them. So I think what each individual has to do is figure out their own kind of inventory of what markets do you have, how much money do I have, how much time do I have, what kind of expertise of computer do I have. All of these different aspects get you into, this is how I should trade. And that's something that you feel comfortable with because you can access it. You have the time for it. You have the expertise for it. There's certain principles that need to be into, what you end up with, but you don't want to try to say, copy me. You might not even be able to legally from some countries.
That's solid advice. Thank you so much. Unless we have more questions, we're really honored to have you very early in your time. And
it's my pleasure.
Yeah, we will do the show notes to your bio and your books. And guys, you can get Thomas Basso's books on Amazon. And any other mentions, we will plug them in on the show notes. For now, we'll let you go and enjoy your coffee and go to your golf.
No, today is, I'm closing down. It's getting cold here in the mountains. I've got a turtleneck on, so I've got to take all the patio furniture, cushions, and get them all stowed away for the winter. In about another few days, we'll be moving back down to Scottsdale, Arizona, where it's a lot warmer. So yeah, the coffee is meant to warm me up as much as anything right now.
Yeah, thank you for the sacrifice. We appreciate you.
Good talking to you again.
All right, cheers.
Cheers. Bye-bye.